Hey everyone, welcome back. If you're here, you already know we dive deep into the world of crypto and finance, breaking down the numbers and market moves so you can understand what's really happening. And today, oh boy, I've got something that might literally blow your mind. I mean, you won't believe how a $10 billion buy could potentially send XRP all the way to $90 per coin. Yes, you heard that right, $90. When I first saw this, I nearly fell out of my chair. And I promise I'm not exaggerating. It all started one late night while I was scrolling through crypto Twitter. You know how it is, trying to catch up on the latest news, memes, and predictions while everyone else is asleep. I stumbled upon a tweet by a guy named Phil Walk, who's not just some random guy on Twitter. He's the co-founder of a crypto app that I follow, and he knows his stuff. But the thing he posted, it sounded absolutely bonkers at first. He claimed that a single $10 billion buy could theoretically push XRP from around $3 all the way up to $90. My first reaction, wait, what? Did I read that correctly? $90. Naturally, I did a double take. At that moment, any trace of sleepiness I had was gone. My heart was pounding like I just chugged a double espresso. I even screenshotted the tweet and dropped it into our free educational Discord server to see if anyone else was awake and could sanity check me. And let me tell you, if you're not in the Discord yet, you're missing out. It's free, fun, and a great place to learn and chat with others about crypto. The link's in the description. So, I started digging deeper. At the time of Phil's simulation, XRP was trading at roughly 297, just about $3, and the total supply of XRP is around 59.3 billion coins. That put the market cap at about $176 billion, which is huge, but still far from Bitcoin levels. Now imagine someone comes in with a $10 billion wallet and starts buying XRP at market price. Phil's model shows that instead of just nudging the price up a little, XRP's price would theoretically jump all the way to $90. I know it sounds insane, but here's the interesting part. This is not magic. It's basic market mechanics at work amplified by something called thin liquidity. Let me explain in simple terms. On exchanges like Kraken, Coinbase, or Binance, there's something called an order book. It shows who wants to buy, who wants to sell, and at what prices. Normally, if you buy a little XRP, the price moves only a tiny bit because there are plenty of sellers around the current price. But if someone tries to buy a massive amount and there aren't enough sellers at the current price, the price starts climbing rapidly. It's like an auction for rare comic books. If you want all the comics, you have to keep bidding higher until someone finally agrees to sell. That's exactly what Phil's simulation showed. AI, buyer gobbling up sell orders from $3 all the way to $90, like Pac-Man eating dots, each dot being a sell order. And when there's hardly any XRP listed at higher prices, the last trade set the new market price, inflating the market cap dramatically. It's a multiplier effect that can make relatively modest inflows of cash appear like they've created enormous value. Now, before anyone gets too excited, a reality check. This is hypothetical, educational, and definitely not financial advice. Crypto is volatile, and market cap doesn't mean all that money actually exists or can be cashed out at once. But understanding how this works can change the way you see potential price movements, supply dynamics, and the power of order books. So, stick with me as we continue to break down exactly how this works, real examples, and why even small inflows can cause massive changes in crypto markets. You're going to want to hear this because by the end of this video, you'll see the mechanics that could, under the right conditions, make wild scenarios like $90 XRP possible, at least on paper. All right, let's dive even deeper. So, after seeing Phil's model, I had to check it for myself. I pulled up real order books on Kraken Pro, one of the exchanges I regularly use. Full disclosure, I do have an affiliate link in the description, but using it doesn't cost you anything extra. It just supports the channel. Anyway, looking at the XRP order book, I could see plenty of sell orders around the current price, roughly $3, but just a few cents higher, and suddenly the sell orders start disappearing. It's almost like a ghost town. That's what thin liquidity looks like in real life. And it was eye-opening. Think about it. If there aren't many sell orders above $3, even a moderate buying push can cause the price to spike quickly. Every extra dollar invested pushes the price higher because buyers have to pay more to get XRP. And that higher price instantly revalues all existing XRP on the market. That's why Phil's $10 billion simulation could create such a massive multiplier effect. A small relative inflow of cash can theoretically inflate the market cap into the trillions. Even though no one is actually putting in trillions of dollars, it's all about the mechanics of supply and demand, and it's kind of beautiful in a financial sense. Now, this isn't just theory. I thought back to something my friend Dom, another crypto analyst I follow, has been talking about for years. Dom is obsessed with order books and liquidity. He tracks exchange data like a hawk, and he's been warning that XRP's order books are thin, that even moderate buy pressure could cause rapid spikes in price. At first, people thought he was exaggerating. I know I did, but his predictions have been proving accurate over time. For example, in late 2023, XRP was trading under $1 for months. Dom noted that if $1 billion of buy pressure came in, XRP could jump several dollars. Back then, it sounded crazy, a six-fold jump from 0.50 or 0.70, but it happened in smaller increments later. Around last December, XRP started climbing gradually. One day, it ripped past $2 in just a few hours. And it was exactly what Dom had been talking about. It wasn't tied to a big announcement or some mysterious news. It was just large buys hitting thin order books. Supply was scarce, and price reacted exponentially. This is key to understanding why thin liquidity is such a powerful force. Most XRP holders set very high sell targets. Some say they won't sell until $10, $50, even $100. That means a huge portion of supply is effectively off the market at mid-range prices. When new money enters, even if it's not billions, it can still create massive upward pressure because there's simply not enough XRP being sold to absorb the buying. That's what traders call a supply squeeze. It's like trying to get a ticket to a sold-out concert. When seats are limited, prices can skyrocket. Another fascinating point is how this ties into real trading examples. Dom tracked XRP trading across multiple exchanges over a 13-hour period in May. Over half that day, there was roughly $61 million more buying than selling. Now, $61 million isn't huge for big institutions, but the effect on XRP's market cap was staggering. It increased by roughly $16.6 billion. That's a 272x multiplier, almost exactly like what Phil's simulation suggested, but on a smaller scale. Seeing this happen in reality confirmed that thin liquidity isn't just theory. It actually works in the market. So the takeaway here is that even seemingly small inflows of capital can have a huge impact on the price if the supply is limited. It also shows why market cap can be misleading. Just because XRP's market cap looks massive at $90 per coin doesn't mean that amount of cash exists or has been spent. It's just the value of all XRP at the last traded price. Understanding this distinction is crucial for anyone trading or investing in crypto. Now we're starting to see how this all connects. The mechanics of the order book, the multiplier effect, thin liquidity, and how high sell targets among holders combine to create massive potential price swings. By grasping these concepts, you start to see why people talk about moonshot scenarios and why 90 XRP isn't pure fantasy. It's just highly conditional, and as thrilling as it is, it's also risky. One wrong move or sudden sell-off can reverse these gains quickly. Now that we understand how thin liquidity works and how even moderate buying pressure can dramatically affect XRP's price, let's take a closer look at that hypothetical $10 billion buy scenario. Imagine multiple large investors or institutions suddenly deciding to pour money into XRP. Maybe it's because of some major news, a regulatory green light, or a big partnership announcement. The order books are thin, just as we discussed. The first few $1 billion push the price up slightly, but then things get interesting. Each additional dollar has to climb higher because there aren't enough sell orders at lower prices. This is where the multiplier effect becomes really powerful. Every new dollar pushes the price higher, which instantly increases the theoretical market value of all existing XRP. So while only $10 billion was actually spent, the market cap could spike by trillions on paper, at least temporarily. That's what Phil's model showed, and why it seems so shocking at first glance. It's not magic. It's pure mechanics, amplified by supply constraints and high holder expectations. Let's also consider human psychology in this scenario. Many XRP holders are diamond hands, meaning they refuse to sell until the price hits their target. Some aim for $50, $100, or even higher. That creates a massive bottleneck of supply. When a wave of new demand enters the market, the coins that are available are snapped up quickly, forcing the price to climb rapidly. It's exactly like trying to buy limited edition sneakers online. The few available sell orders get gobbled up immediately, and the price jumps higher. At the same time, this creates a feedback loop. As the price rises, more attention comes from media, social networks, and retail traders. Fear of missing out, or FOMO, sets in. Suddenly, everyone wants a piece of the action. That means even more demand hits the market, further pushing the price up. But here's the catch. This is also what makes such scenarios risky. If some holders panic or decide to take profits too early, supply suddenly increases, and the price can fall just as quickly as it rose. Thin liquidity works both ways. Now back to the $10 billion example. In reality, it's unlikely that a single investor would drop that much in one trade. It would be self-defeating. They'd drive the price up against themselves and get worse fills. But a coordinated rush of multiple buyers could mimic the effect. If enough money enters the market in a short span, the price could still spike dramatically. This could happen during a global event, a favorable regulatory update, or when XRP gains institutional attention. It's not just a dream scenario. It's plausible under the right conditions. Another interesting factor is how exchanges and order book mechanics interact. The first chunks of XRP are cheap because there are willing sellers. As the buy orders climb higher, sellers see the rising prices and decide to add more XRP to the market, but only at higher price points. So the climb isn't smooth, it's a staircase effect. Each step up reflects scarcity at that price level. And when the last willing sellers finally sell at extremely high prices, the market cap explodes on paper. That's exactly why Phil's $10 billion simulation went from $3 to $90 per XRP. It's also important to remember that real-world dynamics like trading halts, exchange liquidity, and investor sentiment would influence how high the price could actually go. Some exchanges might pause trading during extreme moves, and profit-taking could reduce the momentum. But even with these factors, thin liquidity creates an environment where price swings can be extreme and sudden. So what's the key lesson here? It's not about believing XRP will hit $90 tomorrow. It's about understanding how supply, demand, order books, and investor behavior interact to create potential for explosive price moves. Once you grasp these mechanics, you start to see why even relatively modest inflows of capital can produce extraordinary outcomes. And it also explains why people keep talking about moonshot scenarios. It's not fantasy, it's finance at work. We've been talking about hypothetical scenarios, but thin liquidity and multiplier effects aren't just abstract ideas. They happen in real trading all the time. For example, earlier this year, Dom tracked XRP trading across multiple exchanges over a 13-hour period. During that time, there was about $61 million more buying than selling. Not billions, just $61 million, which is pocket change for institutions. But the result, XRP's market cap surged by roughly 16.6 billion. That's a 272x multiplier effect, almost exactly like what Phil's 10 billion simulation predicted, but scaled down. Seeing that happen in reality confirmed that thin liquidity isn't theory, it works in practice. Another example is last December when XRP was gradually climbing from under $1 to above $2. This was not tied to a big announcement or mysterious news. It was large buys hitting thin order books. Supply was scarce and price reacted exponentially. It happened so fast that people on crypto Twitter were scrambling for explanations. Some thought it was coordinated whale activity. Others guessed it was a leak or announcement. But Dom had already predicted this. He had been tracking sell orders for years and knew that there simply weren't enough sell orders at mid-range prices to absorb new buying. This is a perfect demonstration of how small inflows of money under the right conditions can have outsized effects. What makes XRP particularly interesting is how its holders behave. Many XRP investors have set high sell targets, some aiming for $50, $100, or even higher. That means a huge portion of the supply is effectively off the market until those targets are hit. When demand suddenly increases, whether due to news, FOMO, or institutional buying, the limited available supply gets snapped up quickly. The result is a parabolic price climb. Think of it like trying to buy tickets to a sold-out concert. The few tickets available become extremely valuable as more people try to buy them. This is why supply constraints matter as much as demand. Even smaller moves can have massive effects. In mid-2023, when a relatively small buying wave hit XRP, it triggered a noticeable spike in price. Not because of the amount of money entering the market, but because there were hardly any sellers at the current levels. Each purchase nudged the price higher, which in turn revalued all existing XRP holdings on paper. This is exactly the mechanism behind Phil's $10 billion simulation. It may sound impossible at first, but the math and mechanics check out when you understand order books and liquidity. Of course, we have to temper excitement with reality. Thin liquidity can cause extreme upward moves, but it also cuts both ways. If large holders suddenly panic or decide to take profits, price can drop faster than anyone expects. Volatility in crypto works like a pendulum. The same scarcity that can drive prices sky high can also make markets collapse just as quickly. That's why understanding these mechanics is essential for anyone trading or investing in crypto. You don't want to get caught off guard if a sudden sell-off hits. Another important takeaway is the difference between market cap and actual money invested. Many people misunderstand this. When XRP hits a hypothetical $90, the market cap might look like $5.3 trillion. But that doesn't mean $5.3 trillion is poured in. Market cap is a snapshot of the last traded price multiplied by total supply. The actual cash that moved may be only a fraction of that. That's why thin liquidity matters. It amplifies price moves on paper without massive cash inflows. By now, the pattern is clear. Limited supply at critical price levels combined with large buying pressure creates a multiplier effect. It explains why XRP can experience dramatic price swings even with relatively small capital inflows. And it also shows why the 10 billion hypothetical buy isn't pure fantasy. It's a realistic scenario. If multiple factors align, deep dive into XRP and the $10 billion hypothetical buy. It's important to focus on the lessons and takeaways for anyone interested in crypto trading or investing. First and foremost, understanding market mechanics is key. Price isn't just about hype or speculation. It's a combination of supply, demand, order book depth, and investor psychology. Thin liquidity can create explosive moves, but it also carries extreme risk. That's why experienced traders never ignore order books. They know that small amounts of money can have outsized effects in certain conditions, but those same conditions can trigger equally fast drops. Another takeaway is the importance of planning. Imagine seeing XRP spike from $3 to $30 overnight. Your first reaction might be excitement, greed, or FOMO, but the market doesn't wait for anyone. Setting exit strategies, profit targets, and risk limits in advance can help prevent panic decisions. Whether you're a retail trader or a larger investor, knowing your plan before the action starts is what separates disciplined investors from people who get burned by sudden volatility. It's not about predicting exact numbers. It's about preparation and awareness. Now, let's talk about the psychological side. Many XRP holders are diamond hands, waiting for massive price targets like $50, $100, or even higher. While that behavior can amplify a parabolic rise when demand hits, it can also backfire. If a sudden news event, regulatory change, or market panic occurs, even diamond hands may start selling. That's the other side of thin liquidity. When everyone tries to sell at once and few buyers exist at current, prices can crash dramatically. The same mechanics that create rapid gains can also accelerate losses. Awareness of this is crucial for anyone in crypto. It's also essential to separate hype from mechanics. Talking about $90 XRP is exciting, but it's not a guarantee. Phil's $10 billion simulation and real-life examples like the $61 million buy leading to a $16.6 billion market cap increase are educational. They show what is technically possible, not what will happen tomorrow. Crypto markets are unpredictable, and external factors like news, regulations, institutional moves, and global events play a huge role. Always remember that hypothetical scenarios are just that, hypothetical. They help us understand mechanics and strategy, not promise profits. For viewers on Boolean IQ, the practical lesson is this. Focus on understanding the dynamics of supply and demand, order books, and investor behavior. Look beyond just market cap or price targets. Thin liquidity creates opportunity, but it's double-edged. A moderate inflow of money can produce massive spikes, but it can also trigger sharp drops if conditions change. This is where risk management comes in. Set realistic expectations, know your limits, and never invest more than you can afford to lose. Finally, keep learning and stay curious. Crypto is a fast-evolving market, and understanding order books, liquidity, and market psychology gives you an edge. Use tools like exchange order book tracking, community insights, and expert analysis to make informed decisions. Engage in discussions, analyze scenarios, and simulate potential outcomes. The more you understand these dynamics, the better prepared you'll be for both opportunities and risks. So, while the $10 billion XRP buy scenario might seem wild, it's a perfect case study to understand how crypto markets work. Explosive price moves, multiplier effects, thin liquidity, and investor psychology all come together to create possibilities that may seem impossible at first glance. Remember, this is about knowledge, not speculation. By understanding these principles, you're better equipped to navigate the market intelligently, react calmly under pressure, and potentially spot opportunities that others might overlook.